We live in uncertain times. From my analysis and words from the Federal Reserve themselves, we will be in a high interest rate environment for the next 12 to 48 months at least. This could be a negative catalyst for markets. Are we due for a recession? Brandon Sterling here. It's been a while since I've done a macroeconomic update. Since my last one, market sentiment has changed. And no, it's not due from the US government shutdown. That was a whole distraction. And as of today, they actually managed to avert the government shutdown for another 45 days. So we'll see what happens with that. But in the short term, it is remedied. Now, market sentiment has changed for different underlying factors that isn't being talked about in the news outlets. Big surprise, right? But that's probably why most of you are here that have been following. We cover stuff that the news will never. Now, let's talk debt. A lot of people are sounding the alarms on this debt topic, but let's look at what's going on with debt under the hood and see how it actually can affect GDP, good or bad. Now, in the second quarter of 2023, the percentage of debt in delinquency for all cohorts was much lower than their GFC averages. The main message from this is that the fraction of unpaid credit card debt have been fairly low, but are reverting to levels recorded in the years immediately preceding the pandemic for some age categories, particularly the youngest and middle cohorts, but not for the oldest individuals. So overall, credit card debt delinquency in the second quarter of 2023 is not fully comparable to its state in the GFC, because a lot of talking heads are trying to compare the two. And by GFC, I'm talking about the Great Financial Crisis, the 2008 thing. Even while the percentage of credit card accounts in delinquency for younger individuals is near the GFC average, the delinquent debt as a fraction of total credit card debt is smaller. Data for the most recent quarters, however, suggests that households' financial situation may be stabilizing, particularly for individuals younger than age 40. And also realize real wage growth is positive. Unemployment is pretty low, which means spending could be stable or even increase, which could lead to GDP rising more on this next print. Now, if unemployment drops in the near future and continues to drop, then spending will drop, GDP will drop as a result of that. So the question is, are we due for a recession? Well, not so fast. Remember, to declare a recession, you have to have more than 2 quarters of negative GDP growth. Now, the last GDP print was far more positive than analysts were expecting. US consumer has been spending strongly. The question is, will it remain strong? I have my thoughts on that based on leading indicators that I follow that shows what's coming in the next 6 to 12 months. Maybe that's for another video. For a recession to be official, we would have to go out next year in Q2 or Q3 for that to even be seen as a recession. It's way too early to be calling for that, and to do so is pure speculation backed with no factual basis. Now, the Fed said that they're considering raising rates by 25 to 50 basis points sometime in the near future. Now, it doesn't mean it will happen, but that announcement really broke the market sentiment that a lot of market followers were believing, which was that the Fed is done raising rates and that we'll go back to easing by 2024 through 2026. Now, I never subscribed to that we'll start easing interest rates in the near future. In the Fed's last FOMC meeting, they said inflation is projected not to normalize until 2026. And by normalize, I mean go back down to 2% inflation that they have been targeting for a while now. The Fed has that 2% in mind. They can get there, but it could take time. Could they get there sooner? If they raised rates more soon, yes. But are they likely to? That might not be the case in the near future. But that's the question everyone's asking. Are they going to raise rates again? They're going to keep an eye on consumer behavior, employment figures, etc., to determine their course on that. Now, I said a couple months ago that they could leave interest rates where they're at right now, and they have kept the interest rates the same since I've said that. Inflation could go down to the 2% target that they have in mind. Now, inflation is not too far from that. We're in the 3% range. With oil prices rallying the last couple of months, this could affect consumer spending potentially. This could make people spend less money on goods or services, which would result in lower GDP, which would result in the market dropping, of course. This all could happen because of higher gas prices, so we'll keep an eye on that. Now, those of you in my Capital Markets Club could have seen that smart money, as of large, the hedge funds, well before the oil rally ever even happened. So far this year, we've had a good run in the stock market. We're still sitting above the bull market level. So yes, we're still technically in a bull market as of right now. The market is above the 4203 market level in the S&P. So the market is above a 20% retracement level from the 2022 October low. But it's important to outline data points we're seeing that could potentially bring markets down in the near future. Now, if I'm a long-term investor, this doesn't mean panic and sell out of all of my stocks. I do a lot of quantitative studies, and part of that is looking at market participation. What is going on with the various indices like the S&P, the Dow, the Nasdaq? But what is actually happening with the individual stocks that make up the whole market in and of itself? That consists of about 5,000 to 7,000 stocks in the US market. And so looking at the behavior in constituent stocks can display for us what's going on under the hood of the market. Now, market breadth is a tool to measure this. So market breadth right now just touched below the February 2020 level. Now, we got to a level in market breadth recently where we've only seen touch about 12 times now in a 10-year time span. And one of those is the February 2020 level. So that's why I have it outlined in the blue line, as you can see here. These levels basically mean one of two things. Either we're going to see a correction, or that a market may be bottoming or getting close to it. Most of the time, it's the latter. In the rare occasion it is right before a black swan event takes place, that can also be another thing. It can get to a point, though, where sentiment in the broad market is so bearish that institutional players start to buy up the pieces, and that starts a short squeeze and a buying frenzy. So this isn't the end-all be-all of my portfolio management decision-making, but it is to provide supporting data that feeds into my macroeconomic and fundamental analysis. So you can either be concerned about this, or you can see this as the market kind of bottoming, and we'll see the buying frenzy and short squeeze. It could be one of the two things, or a black swan that we don't know about yet that could take place in the near future. It can be any one of those, which, to be honest, no one truly knows until we get there. This is demonstrating there is risk. With all that said, I just went over, though, and really any point, there's always downside risk in the markets. That's why it's important to hedge out our portfolios and hedge out the downside risk. Positioning our books for potential tail risk in the stock market. So I can hold on to my long-term stock investments, but it doesn't mean that I can't at the same time hedge out the downside risk and offset the loss that I would have incurred. There is also never a 0% chance of a unexpected black swan event from happening or changes that could take place in the world stage. When these things happen, they can be a catalyst to bring down the stock market. Some of you may have been hesitant to invest in the stock market due to downside risk fears. Most people contribute to their 401ks or invest in their personal accounts by buying into the market and hoping one day they can sell at a higher price. What if I plan on doing that, but in between, I could hedge out the downside risk, spending very little of my portfolio's value? With a hedge in place, I could actually make money on the market if it doesn't drop. I still outperform the broad market and those who didn't have the hedge in place. Now, doing a quantitative study and comparing the returns of those just long versus those long with the hedge, we can see that the data supports that those with the hedge outperform those without one. You can think of a hedge as a house fire insurance policy on your home. With the tools we all have access to nowadays, anyone with the right direction can hedge out their portfolio. It doesn't require some advanced math nerd equations on a whiteboard to do this. On October 12th, 7 p.m. EST, I'm hosting the How to Hedge Stock Market Risk Exposure live webinar event. The recording and materials will be available for those who sign up and couldn't make it to participate in the webinar live on October 12th at 7 p.m. However, when you are live participant, you will be able to participate in the Q&A that we're going to have towards the end. In this webinar, we're going to cover what to invest in, how to structure and start an investment portfolio, and then I'm going to demonstrate what is a hedge. Now, we're going to go through different kinds of hedges that are useful, and how each one can apply to different kinds of portfolios. Those of you that will access this webinar will walk away with a skill set to hedge out their portfolio for a lifetime. I'm going to demonstrate how to use and repeat this process in an easy to understand way. This framework will allow you to hedge out downside risk in the long haul. Now, recording of this webinar and instructional PDFs will be available for those who purchase a ticket. You can submit a request to join this webinar using the link below. So that's it for me for now. I will see you guys in the next video.